It's really simple. Old property. Many people think that old property doesn't get depreciation. It does. Yes, it's not as much. Yes, it runs out faster, but it usually does get some depreciation. Before you dismiss it and think it doesn't, maybe ask the question. Let's run the scenario. Not quite as detailed this time. It's an old house. It's not a new swishy looking unit. Bought for $300,000, let's say. Rental of $280 a week. I can give you a copy of these slides, by the way, if anyone wants them. Just email me afterwards. What difference does it make? $35 a week. We found $5,000 in deduction, not $15,000 out of the newer property, $5,000. Now, year 2 is going to be a fair bit less on this property. We're talking about the first year here. But would you do it for $35 a week difference in the cost of owning in the first year? The answer is probably yes, because you're going to get some money back. Old property still gets depreciation. Ask the question of someone who knows whether it will before you dismiss it, is all I'm saying there. Now, this deduction that you get to make at the end of the financial year across the board in your property can also be adjusted weekly to get taken out of your income, take less tax out of your income by your employer. So speak to your accountant about that one as well. Rather than a lump sum at the end of the year, you can get it done on the way through. Help your cash flow. Why do we get involved in this? Why does this Quantity Surveyor building cost estimator guy do a depreciation schedule, you might ask? Here's the answer. The depreciation we talked about being related to the construction cost of the building in some way, because it's the building getting older and wearing out. The tax office says where we don't have all of the costs available, we want someone who knows about construction costs, or they say they'll accept the cost estimated by a relevant professional such as a quantity surveyor. Because we measure up bricks and concrete and all that stuff all day normally as a job as a quantity surveyor. They'll accept the estimates we come up with for the purpose of depreciation. Not your accountant, not your solicitor, not your real estate agent, and not your valuer. Valuers value property. They don't know about construction costs, usually. So don't use valuers to do depreciation schedules. So this is about compliance. This is about making sure Mr. ATO doesn't come after you and say, where did you get your costs from? We will put costs on it that we are happy with, that we believe, because we know and estimate construction costs of buildings. The other part's also about maximising the deduction, knowing what you can and can't do. Just because you have all of the costs doesn't mean you know how to treat them to get the maximum deduction either. We do know how to treat them. Some quantity surveyors just estimate construction costs. Some will specialise in depreciation schedules. You need to make sure you get someone who knows about the depreciation rules, not just about costing up the building, basically. In order to do that, firstly, probably one of the main things that happens is the Tax Practitioners Board has made us all become tax agents as quantity surveyors for the purpose of preparing depreciation schedules. I don't do tax returns. I'm not an accountant. Don't want to do those. That's all those other numbers. I just want to play with the depreciation numbers. We're tax agents so that we can do depreciation, not your tax return. I want to make sure that the person is that does that. It's really the ATO trying to clean up the depreciation industry and saying we want you to know some rules about tax, not just how to cost up buildings, basically. So we're those. We're members of the Australian Quantity Surveyors. We're valuers, plant and equipment valuers to help us value stuff, but need to be obviously members of the appropriate things. Doesn't my accountant look after that is probably the most common question I've had all weekend talking to people about their depreciation. The answer to that is we work alongside your accountant. Your accountant is my friend. Most of the time, all of the jobs that we do for accountants, that we do for investors, is because they didn't really learn about it very much at the start. They went off to do their tax return. The accountant says, ring up the quantity surveyor, BMT we hope of course, ring up the quantity surveyor, get a depreciation schedule so he can plug that number into the tax return. And it takes the risk away from him because he knows he shouldn't estimate construction costs, or she, sorry. They know they shouldn't estimate construction costs. So if we do it instead, it's our risk, and we know how to estimate construction costs, so I'm not scared of that risk, basically. They're our friends most of the time, our jobs. We are 100% happy for you every time to go and talk to your accountant before you do a depreciation schedule. Make sure they're happy with it. If they're not happy with it, maybe ask the question about why, at least, and we'll talk to the accountant, if you like, about why it should work on your property. See, sometimes accountants don't realise that old property still might get depreciation. A lot of them do, but some of them don't, or think maybe it's not enough to spend the money. But we'll check that out before we go ahead and do it. I'm going to harp on old property all day because people always seem to think it's no good on old property. I had so many discussions over the weekend about I've got my property, it's 15 years old, I didn't think it was worth it. Always ring and ask the question before you dismiss it. When do we apply it? Before you buy any type of investment property, I believe you should learn a lot of things and crunch your numbers. Work out whether or not you can afford to own that property. That first property we looked at had a fair bit of negative cash flow. That might not be right for you. Some people like it. Some people it's good for. But crunch the numbers first. You can easily work out how much interest you're going to need to pay the bank. These guys will help you out with that. The rates are pretty easy to work out. How much rent you're going to get is pretty close to working out. Depreciation is one of those numbers you need before you buy. Don't buy something until you crunch the numbers on how much it's going to cost you to own it. So online there's a depreciation calculator that we've got. It's also an app and an Android and all those things on your iPad, whatever. So you can actually estimate how much deduction there might be on a property you're looking at buying. Before you buy it, go and use it. It's free. Use it 1,000 times. It doesn't cost you anything. Now, we're also not just a website. We're people. There's 170 of us at BMT. Ring up. Ask some questions. It doesn't cost you any money to ask how much depreciation you might get out of a property you're going to buy. Flick us some photos. We'll have a look at them. We'll give you for free an indication of how much deduction there might be before you buy it. Now, if you buy the property, I'd love to do the depreciation schedule after, because I also do want to charge you some money to find the deductions. You're going to need that later. But before that, get armed with some information. When you're asking your accountant whether or not you think you can afford to buy this property, go armed with some numbers. Use the calculator, ask some questions first. It's really easy. You can go back. So if you're a current investor here today and you didn't know enough about depreciation, or you didn't do it properly, it's like if you don't pay your tax to the tax office in Australia, they will find you and they will make you pay it eventually. They'll give you a fine as well, probably, if you're unlucky. It kind of works the other way as well. If you don't make your deductions, like depreciation, you can go back to Mr. Tax Office and say, I didn't claim my $15,000 or $5,000 or whatever it is last year. Can I make a claim now? And the tax office will allow your accountant to amend your tax return and give you some money back. We're investing in property for money, get it. The other thing is if you're not maximising that deduction properly, which is the most regular thing we see. So if that deduction could be $15,000 and you're only claiming $10,000, you can go back and amend the difference. So have a look at your tax return, see what you're claiming. If someone's guessed and you haven't got all the deductions, get it looked at and get it fixed up, because you might as well get the money back from the tax office if you can. Like to mention around here the guarantee. We talked about old properties, and some people and some accountants are concerned. They don't want to tell you to go and spend money at the Quantity Surveyor and not get some deductions. We'll talk to you about your old properties. We'll talk to you about your current claim and what you're claiming. Well, if we think we can get you some more, we'll tell you we can get you some more. If we don't, we'll back it. If we don't find you deductions that are twice as much as the fee in the first full year, we'll give you the money back afterwards. Because my guys will ask, and girls will ask, enough questions about your property to make sure we're going to find some deductions. No use you spending money at the Quantity Surveyor and not getting some money back afterwards. You should be able to find this out before you go ahead and do anything, really easily. You should ask questions. New property, old property. I mentioned that again. Refurbishments. If you refurbish a property, you change what's there, so you change the cost of what's there, so of course you'd change what you're able to depreciate. So if you refurbish a property, you might need to look at it again there. Now, I've blanket called it depreciation so far. A little bit more technical about how it's done here. It's split up into two areas. The first one is what we call the building allowance, or Division 43 allowance. Well, we don't call it that. The tax office calls it that. We call it that afterwards. What that is a 2.5% deduction is a 2.5% deduction of the construction cost of the building each year. So how this works is it does actually have a specific date that matters. So I talk about age not mattering, and don't worry about old properties, but in order to claim this deduction, the property needs to be built after 1987. So if it's built before then, you don't get anything on the structure, the concrete floors, the walls, the roof, the hard stuff that lasts a long time. And we're moving slides. Thank you very much. Sorry about that, throwing stuff around. How this one works is, let's say this house here was built in 2010 for $260,000. It gets 2.5% of that as a deduction each year, which is $6,500 each year. If you had bought this property new in 2010, you'd be getting $6,500 per year for 40 years, so till 2040. If you buy it in 2013 now, just means you don't get the first 3 years. You get the 37 that are left at $6,500 each year as a deduction. So anything that's built after 1987 gets this claim against the structure of the building. So newer properties after 1987 generally get more deductions because of this reason. This applies also to some renovations. So if you buy a property that's built in 1927, let's say, and then in 2005, someone comes along and adds another room, puts a new kitchen and a new bathroom in it, you still get nothing on the original structure, but you get stuff on the new stuff that's been done. Sorry, you get deductions on the new things that have been put in there at 2.5% of the cost of those things. Whether you did it or the previous owner did it, doesn't matter. We'll estimate what that costs at the time if you don't have all the costs there available, and you'll get to claim your deductions on that. Okay. If you buy a property that's 10 years old, you miss out on the first 10 years. You've got the next 30 years to run that you still claim this deduction. One of the reasons that newer properties often gets more depreciation is because of this. Firstly, newer properties, well, largely because newer properties cost more to build. Construction costs rarely go down. They usually always over time go up. So this house, if it was built 10 years ago, would probably cost less, if it was very similar 10 years ago, to what this house would cost to build today. It's one of the reasons more deductions come out of newer properties. Plant equipment is the other part, or Division 40. These are things like carpet, hot water services, stoves, blinds, curtains, some light fittings, air conditioning systems, generally things that don't last as long. Because they don't last as long, they wear and tear quicker, the tax office puts what they call an effective life on these things and says, we'll claim them over 10 years instead of 40 years. Because in 10 years, they're probably going to be worn out, for example. So the tax office says a dishwasher should last 10 years. So we kind of claim a deduction over 10 years. Just remember the dishwasher for a while. It's got a 10-year effective life. I'll tell you a story about that in a moment. There's no age restrictions on this plant equipment. There's no special 1987 date that says you can or can't claim depreciation on it. But it comes down to value. If you ring up and say, I've got this house, Brad, it's built in 1927, and the original carpet's still there, please replace it to start with. But if it is still there, I'm not going to be able to put value on it because it's no good. It's done, it's had its day. However, if you buy an old property that's built in 1927, hopefully someone's done some work on it at some point. They have had to replace some things that have broken down. The hot water service has been replaced at some point since 1927. In saying that, I bought a house a couple of years ago with a hot water service that was from 1978 and it was still actually working, believe it or not. I threw it away and got a new one anyway, but I don't think it was going to work for long. But there's no age restriction, but I've got to be able to put a value on it. So when we talk to you about an old property, when you thought, oh, probably wasn't worth it, but then you ring us and think, Brad said it is worth a phone call, we'll ask you a few questions about your property and decide whether or not we're going to get some deductions. Is your carpet from 1927? Is your hot water service from 1927? A few questions like that about what's in your property. Has someone put a new kitchen in it 5 years ago? Is a question that we'll ask, because then we'll get some building allowance against that kitchen, even though it's built in 1927. It's okay, we'll find some deductions out of that. So we'll be able to gauge whether they're going to get some deductions out of your property by asking you those few questions. How's this one work? We'll take the dishwasher again. Let's say it's bought or put in there for a cost of $1,350. We get to claim 20% of that in the first year. If it's a full year, $270 as a deduction in the first year against that dishwasher. Much more than 2.5%. 2.5% of $1,350 is not very much money. The more dishwashery type things I can find, the better, because I get more deductions in the early years of ownership. One way we get more deductions out of the property. I'd like to touch on something we call scrapping.